Now that more than 50% of the stock market value is taken up by passive funds, and this is probably growing, is the market still as volatile and subject to extreme crashes?
Wow. So, first of all, the market has been more crashy since the year 2000 than it was previously. Remember the lady we had on The Economist, and she said that half of the major crashes that she'd studied had been post the millennium. So it's actually kind of more crashy, not less. And you would think that, or people might argue that if the market was passive, it would be less crashy because there's less people kind of buying and selling. But I actually think that the bigger trend that's maybe leading to the markets being a bit more volatile is the ease of purchase and sale. So the ability for retail investors who are buying passive funds, who don't really understand what they're buying or how the market reacts, they've not really internalized from question one that crashes are normal, have this ability now to get out of the market in an instant. They can see a news headline or a clickbait title and they can sell their whole portfolio in 10 seconds. In the past, there were lots of barriers to receiving information. You have to go and get a newspaper, or if you didn't walk past the headlines that day, you just wouldn't see it. Now you can't escape it on your feed, or you would maybe have to watch a certain channel. If you turned on the TV at the wrong time, you didn't see the news, kind of thing. And then there was you had to internalize that message, go away and go, okay, well now I'm going to sell, pick up a phone, call your broker, get through to your broker, who's then probably going to be like, try and talk you down and be like, you probably shouldn't sell everything. There's all these barriers that just allow people to cool down. Now, think about impulse buying products. I see a product on Instagram, buy it, it turns off. It's always a scam.
So much.
Always a scam. But that impulsivity in humans feeds now into the market. And I think that's probably leading to wilder swings because of the amount of retail investors in passive funds that they can just dump. We found this thing in The Economist. It's like this dystopian story that they tell that is sort of it's like the fable of active investors, where they describe a world that in 2034 here, they say that the whole of the stock market is just the Magnificent Seven, and Nvidia make up like 80% of the market and all of this stuff, and the threat that would pose to the economy. I think, what the active people don't say is the threat that they pose to people's portfolios is the extraction of fees. And that's a very certain risk. All these guys talking about how passive investing is so dangerous while they're creaming 2% of your portfolio off the top to not beat the market is just as dangerous. But anyway, 50% of funds are passive, not 50% of the market. People say this all the time, 50% of the market. No, 50% of funds. There's still 49% of active funds. And then there's a whole load of other people that are just buying individual shares, including most passive investors. I think there's a long way to go before passive investing completely dominates the market. Maybe it leads to some kinds of distortion within the market, money just flowing into the hands of the biggest companies and things like this. But they've been saying this about passive funds now since they were basically created. And lo and behold, they've just kicked the arse of active investors over that time.
It is in their best interest to try and drive people towards active because they're getting their commission.
Well, this is it. And, smart people like to think that they're smarter than the dumb option.
And you can beat the market and you're like, oh, I can...
The one thing that's going to annoy me is the 1 year, which will happen, where active investors beat passive investors, and they'll be like, "I told you," and it's like, you've been wrong for 20 years. You can't just go.
The one win you've had.
The score is 20-0. You scored one goal and you're celebrating. Do you know what I mean? It's like you've been battered.
But I think a lot of people most people start off like actively choosing their stocks and shares right when they start investing, and then move to passive funds. I think. So. They still they've got a lot of drive and momentum behind them. It's like everyone's like, oh, I can be smart. I know Amazon's good. Oh, I want to buy Netflix. I'm going to beat the market. And then...
This is a really good point, T. So, the assumption is that anyone who's active is somehow smarter and making intelligent decisions. How much of the active market is just people buying the hottest stock of the moment and distorting that price? Yeah. How much of Nvidia's rise has just been because people have seen the line going up and they've just got involved?
So many people told me, buy Nvidia. And I'm like, this is the first time you ever talked to me about investing, and you're telling me to buy a specific stock.
So it's funny telling you, where's your podcast? You know what I mean?
I'm like the cheek of it.
Yeah. Little baby T. Your capital T, mate.
Yeah, you're lowercase T's out here telling me what to do.
Lowercase T's. No, but it's a good point, isn't it? All these people criticize passive investing because of its passive nature and it just buys the market and it might distort the market. But if everyone was active and you just got people running around buying whatever's going up in price, is that not going to distort prices? Yeah. I think the biggest shift is just the ease of purchase, not the fact that passive funds are there. Yeah. I would rather every normal Joe, like every normal person be in a passive fund than be going, oh, well, I've got to actively pick. And I think what a lot of the active side of things is saying is, well, you need to pay us to pick for you. And I just don't see credible evidence over, a long time horizon that those guys consistently are good at doing that. We're not even answering the question here. The question was about volatility and choppiness. Since the rise of passive, it's become probably beyond 2000. I mean, it started in the 70s, really kicked off in the 90s, 2000s. The markets have been choppier. But you're going to blame COVID on passive funds,
You can't. There's a lot of factors, and especially the ease of being able to buy and sell. And like you said, like people used to get newspapers, but by the time it's printed, the news is already 12 hours late or whatever. Yep. And by the time you read it, it might be like the end of the day. So you're reading at 5 p.m. But we see it on I wake up and the first thing I see on my, I get messages on Telegram saying Bitcoin price, I get this, about Nvidia price, I get this. Just
about the California fires, whereas in the past you wouldn't have even known that was a thing.
Exactly.
Back in the day you'd have known the next village down. Now you're just a constant news feed of the world's dramas. Yeah. To quote Billy Joel, we didn't start the fire. The world's always burning. Since the world was turning. Yeah. So, I think it's the speed of access to information, the negative news cycle, and then people's kind of reaction to that and the immediacy that leads to more choppiness. Yeah. I don't think it's necessarily passive funds. That was a clip from our episode where we answered your investing questions. If you want to watch the full thing, you can do that right here.